In 2024, a company called iLearningEngines rang the opening bell at the NASDAQ stock exchange, valued at roughly $1.5 billion. It called itself a fully built, out-of-the-box artificial intelligence company. In April 2026, federal prosecutors said almost none of that was real, and indicted both its former CEO and former CFO for fraud, on charges that carry a maximum sentence of life in prison. To understand how this happened, you have to go back further than 2024. iLearningEngines wasn't actually a brand new startup chasing the AI wave. It was founded all the way back in 2010 by a man named Puthugramam Chidambaran. For more than a decade, it was a fairly unremarkable company, quietly selling training and education software to corporate clients. Nothing about it suggested a billion-dollar future. Then came 2023, and with it, the biggest investment gold rush in tech since the dot-com era. Every company with even a loose connection to artificial intelligence suddenly seemed to be worth 10 times what it was the year before. iLearningEngines didn't miss the moment. It rebranded itself almost overnight, repositioning from a training software company into what it called an AI-driven business automation platform, complete with an out-of-the-box AI platform pitch that sounded exactly like what investors were desperate to fund. Instead of going through a traditional IPO, the company merged with an already publicly traded shell company, a faster, less scrutinized path to the stock market. It worked. The listing went through in 2024, and almost immediately the valuation rocketed past $1 billion, fueled by little more than the right buzzword at the right moment in history. Here's where it gets specific, according to federal prosecutors. The indictment alleges that Chidambaran and the company's then chief financial officer, a man named Syed Farhan Ali Naqvi, didn't just stretch the truth about how the business was doing. They allegedly fabricated almost the entire business. Prosecutors say the company told investors and lenders it had real, paying customers, including healthcare companies and school systems, all licensing its AI education platform. But, according to the indictment, a huge number of those customer relationships were never real in the first place. Prosecutors allege the two executives used forged, sham contracts, paperwork made to look exactly like legitimate licensing deals attached to companies that, according to the government, weren't actually paying for anything. On paper, it looked like a thriving, diversified customer base. In reality, prosecutors say, it was largely fiction. So how do you make fake revenue show up as real cash in your bank account? This is the part that should genuinely surprise you. According to the indictment, the executives allegedly used what's called round-trip transfers. Picture it like this. Investor and lender money goes out the door, travels through a chain of accounts, and comes right back in. Except now, on the books, it looks like a customer payment instead of the company's own money circling back to itself. It's financial sleight of hand that, if it works, makes a revenue chart climb in a perfectly smooth, perfectly convincing line. And, for a while, it did work. The numbers looked clean enough to pass through. Analysts modeled future growth off of them. Investors bought in based on a story that, on paper, looked like one of the great AI success stories of the decade. Stories like this rarely collapse in one single moment. They unravel slowly, and then, all at once. It started the way most fraud cases start. Skeptical short sellers and financial analysts began asking uncomfortable questions. Why did a company with this much claimed revenue have customer documentation that was so thin and so hard to independently verify? Why were so many of its supposed enterprise clients impossible to find any public trace of? Those questions turned into formal investigations. As scrutiny mounted, the financial picture that had looked so clean began to fall apart, and iLearningEngines eventually filed for bankruptcy, a stunning collapse for a company that, less than 2 years earlier, had been celebrated as a billion-dollar AI success story. And it wasn't just abstract numbers on a balance sheet that disappeared. When a company built almost entirely on fabricated revenue collapses, real people are left holding the loss. Retail investors who bought iLearningEngines stock after watching it surge through 2024 watched that investment become worth a fraction of what they paid, almost overnight. Employees who'd taken jobs at what they believed was a genuine, fast-growing AI company found themselves out of work when the bankruptcy filing came through. None of them had any way of knowing the revenue figures they were trusting. The same figures analysts were using to justify the stock's climb were allegedly built on circular transfers and forged paperwork instead of actual paying customers. That's the part of these stories that rarely makes the headlines. The executives at the center of a fraud case like this one usually have lawyers, severance arrangements, and, in some cases, years before any verdict is ever reached. The people on the other end of the transaction, the ones who trusted the numbers, usually don't get any of that. They just get the loss. And only a year later did the case begin moving toward any real consequences for the men accused of causing it. Then, in April 2026, the story crossed a line from financial scandal into criminal prosecution. Federal prosecutors in Brooklyn, New York, unsealed a 10-count indictment against Chidambaran and Naqvi. The charges included running what the government calls a continuing financial crimes enterprise, along with securities fraud, wire fraud, and conspiracy to commit both. That first charge, the criminal enterprise charge, carries a maximum sentence of life in prison. Chidambaran was arrested at his home in Potomac, Maryland. Naqvi was arrested across the country in San Jose, California. Both men have been charged, not convicted. The case is still working its way through the federal court system. And as of now, no trial date or verdict has been reported. Here's why this case matters far beyond one AI company most people had never heard of before this story broke. iLearningEngines isn't really an isolated incident. It's a symptom of an entire investment climate where the single word AI was enough to unlock enormous valuations with almost no real financial scrutiny attached to it. Billions of dollars moved into companies in 2023 and 2024 based on pitch decks and buzzwords, not audited, verifiable customer relationships. So, if you're the kind of person who looks at stocks, or even just pays attention to which companies are making headlines, here's the pattern worth remembering from this case. Revenue that grows impossibly fast with no obvious explanation. Customer contracts that nobody outside the company can independently verify. And a sudden, suspiciously well-timed rebrand chasing whatever the hottest buzzword of the moment happens to be. Those three signals showed up here, together, and they will absolutely show up again somewhere else. The uncomfortable truth is that the next iLearningEngines is very likely trading on a stock exchange right now, under a different name, with a different shiny pitch deck, and almost nobody is checking the math behind it. If stories like this, the ones hiding in plain sight inside billion-dollar companies, are the kind of thing you want to see more of, subscribe. We're already tracking which company might be next. And if you're new here, this channel exists for exactly one reason: to dig past the press release and show you what actually happened inside the companies everyone's talking about. That means real court filings, real numbers, and the parts nobody bothered to fact-check. Comment below with the company you think deserves this treatment next. We genuinely use those suggestions to plan upcoming videos. Hit the bell so you catch it the moment it goes up.